how do I go about building that 2030 portfolio? Give me some alpha over the index. How do I go about building that? What are the top 2-3 things that I need to look out for to say, okay, you know what, this ETF is fine and I'm going to stick with it for the next, let's say 3, 4, 5 years.
For any passive product, the most important, I would say, statistical number is what you call it.
Why would I go and choose ETFs and not, let's say, mutual funds or index funds, which are relatively simpler?
The best way for you to buy India is to buy
Mutual funds and PMS. Which side do you use? Vishal, thank you so much for your time. Really appreciate it. As per my research, I've read that you were the member of that team who first launched ETFs in India. The very first ETF was Nifty Bees, if I am not wrong. And you were the founding member or part of that team. Can I call you the father of Indian ETFs then in that case?
I mean, I don't know if father is the right word, but well, Rahul has been a 30-year journey now. I've been associated with passive products, all the way right from 1996. Yes, I was one of the initial members of Benchmark Mutual Fund, which launched, the Bees products which are there in the market, whether it may be Nifty Bees, Junior Bees, Gold Bees, Liquid Bees. These were the popular products that we had launched, during the decade 2000 and 2010. I've been associated with ETFs all the way back since 2000 and all the way up till now. The journeys had many ups and downs. I would split the journeys maybe in 2 or 3 different parts. I mean, out of the 30 years, the first 15 years, I would say, were the initial phase where we were launching products. A slightly difficult period as well, because adoption at that point of time was very limited. As compared to, if you see the kind of growth in the last 4 or 5 years, it's been amazing. I've got to meet great founders, right from, those guys who set up Benchmark Mutual Fund to now, young folks from Zerodha Broking and Small Case who are our joint venture partners. So, I mean, many more milestones to hit and long way to go even now.
I think it's fascinating to know that almost 30 years of ETF, ecosystem, if you like, and how it has evolved, right? Last 5 years, totally agreed. The kind of awareness now about ETFs is just huge. Everybody is comfortable, speaking about ETFs. But one of the things that, Vishal, I right now see is a lot of confusion, because a lot of ETFs have been launched, right? Be the normal, broad indices to sector specific ETFs to, let's say, smart beta ETFs, right? If for an investor, it's extremely hard, right? Because if a retail investor is trying to do it on their own, my question to you is, let's say 2030 portfolio, okay? I'm building a 2030 portfolio. I'm not even looking at short term, right? My first question to you will be, why would I go and choose ETFs and not, let's say, mutual funds or index funds, which are relatively simpler? Because concept of ETF is slightly complicated, as far as my understanding goes, and you can tell me whether I'm saying incorrect things here. So why would I choose ETFs and why would I build a portfolio of ETFs for 2030 goals that I might have? I think let's start from there.
A couple of, let me just step back and possibly talk about passive, and then talk about ETFs and index funds, separately. Why should passive be part of your portfolio, right? First thing, passive is very simple to understand. Today, if I asked you, what was, say, the index during the crash landing of the 2020 COVID crisis,
right?
There'll be some number you'll at least come up with. But if I ask you, Rahul, what was the price of Reliance on that day, right? There'll be chances that you may not know.
I don't know.
Yeah. So,
to be honest, yeah.
So an index is a very visible product. We track it on a day-to-day basis. It's a very easy product for someone to understand. It's a very transparent product, right? So at any given point of time, you know exactly where your money is going in, and there is some history to it, right? And and it's low cost. So that's the most important thing, that is there. So it's easy to understand. It is transparent. It is low cost, and therefore it kind of fits into your portfolio in a very simple way, especially when you look for the long term.
Right.
Right. Passive strategies also are very razor sharp in terms of the strategy. So if I told you, look, here is a top 100 index, large cap index, these are exactly the top 100 companies in India, right? They're the top 100 companies that are there. If I came and told you, look, Rahul, this is a mid cap 150 index, right? You know exactly that these are all the mid cap companies that are there in India. It's very easy for somebody to kind of understand and therefore place in your portfolio in a very simple manner. Now, if somebody came and said that, look, Vishal, I want to buy India, right? The best way for you to buy India is to buy, a diversified index maybe of 500 companies or so. Right. That's the easiest way for you to sit on the India growth story.
Right.
You don't need to sit there and research which sector, which stock, which fund manager, which scheme. It's a very simple strategy for you to kind of place into your portfolio, right? You need to also step back and understand in the sense that, look, why am I getting into the market? I'm getting into the market I understand 2 or 3 simple reasons. The reasons tend to become complex as we start diving deep into the market. But to me, the basic reasons are there. We all believe in the India growth story, right? And the second thing is you want to beat inflation. That's why you're there in equity, right? To me, I think these are the 2 main factors why you should be getting into equity, because you want to beat inflation. You putting money, say, into a fixed deposit is not going to go anywhere beyond a point of time, right? So you need to take a bit of risk in your portfolio to be able to kind of beat inflation, right? Now, the easiest thing for you to do is to just buy a diversified index and stay put in the index, right? Because at any given point of time, these are the 500 best companies that are there in the market.
Right.
Now, you might be slightly more evolved. Maybe you'll say that, look, index is something that a 500 stock index I don't have much control over, right? You could kind of split that strategy again using passive products. You can say that, look, I want to take a little bit more of risk, right? So a 500 stock index would possibly have maybe 65% large cap, about 20% mid cap, and maybe about 15% or so, 15-20% or whatever is left would be small cap. But you come back and say, no, I want to take a little more risk. So you could split each of these 3 segments using a passive product, and you could build a portfolio where you say that, look, instead of large cap being 65% in your portfolio, I want it to be only 35%.
Okay.
Right. And I want mid cap to be 35%.
Right.
And I want the small cap portion to be 30%. Right.
Okay.
You could actually build your portfolio like a Lego block.
Right.
And that's the ability that a passive, product kind of gives you to build a portfolio. Now, should you be doing an ETF? Should you be doing an index fund? I think it just depends on your convenience. They're 2 very different structures, but instead of getting, into complexity, I would say that, look, if you are a person who has a demat account, a trading account, and is a person who's very comfortable with the markets, then go for the ETF.
Right.
If you're a person who, wants to kind of automate your investment, doesn't, is not too averse with the stock markets or doesn't get into the stock markets or trade on a day-to-day basis, and you want to do SIPs, you want to kind of automate that investment, then go for an index fund is how I would split it in a very simple way.
Okay. So you're saying that if you want to keep your investing simple, right, passive is good for you. Of course, if you want to play around and, choose specific strategies, sectoral, bets or whatever, then of course, active is your way. Now, within passive, we got ETFs and index, and you're saying that if you're more evolved, want to get involved, right, have a demat account, want to see things, feel them, then ETFs is the way to go. While if you're hands off, then maybe index funds are better suited for you.
That's right.
Okay, understood. Now, within ETFs, then Vishal, there are so many choices. Okay, and as you rightly said, it depends on me as an individual that if I'm going for an ETF which is covering all 500 stocks as per the 500 ETF, 500 index, or whether I want to split my money, right? Now, a lot of people, if they wanted to do Nifty 500, then there could be ETFs, I don't know, right? They can go and explore those. But let's say a person wants to say that I want to beat the index returns. Okay, I'm not happy just with the index return. So, I don't know, traditionally if index has given 10% or 12% or whatever, I want to get to at least 2%, 3% alpha. I want to get a bit more, and I'm okay because I know, markets will go up and down. I'm happy to sit down with this volatility. I'm happy to wait for 5 years. In that case, what factors, on what basis do I decide that I'll go for these 4 ETFs or 5 ETFs? And is it just about the equity? Because for a balanced portfolio, in my view, you got to have other aspects as well, be it debt, gold, silver, I don't know, the commodities. So what how do I go about building that 2030 portfolio, which is long term, quite long? I mean, it's not like hugely long term, but at least 5 years is a good, time horizon that I'm giving to market to work and give me some alpha over the index. So how do I go about building that?
Look, the first thing, again, I'll step back and, let's talk about, what is your objective of getting in the market? Again, objective of getting into the market is to beat inflation, to sit in the India growth story. I would tend to think that the easiest way for somebody to do that is to kind of split your portfolio into a core and satellite. And
Okay.
what do I mean by that? I mean that the core portion of your portfolio is what is your basic objective for being in the market,
Right.
Where you could load your portfolio, depending on your risk-taking ability, load it towards as much as you want. So let's take a simple example. The core of your portfolio, we split it, assuming that I have $100, right? I make the core of my portfolio, say 80 rupees, and I make the satellite portion, say 20 rupees. Now, the 80 rupees is something where I need to actually build my asset allocation, which means that I need to build the equity portion. I need to build a bit of my debt portion. I need to build a bit of my commodity portion there. Why commodity? You raise the point of commodity. Important to have gold in your portfolio because gold is one of those few asset classes that is very low, that has a very low correlation with equity.
Right.
So if there is any untoward, event that happens in the market, and we're already, kind of seeing it, it's gold which kind of cushions your portfolio at that point of time. And therefore, you can kind of build that 80 rupees portfolio in a split between, say, equity, debt, and gold. Generally, a rough number that people talk about, again, it's not very scientific, but it's a number that people always say is that have about 15% of your equity portfolio as your gold. So,
Right.
assuming that, out of the 80 rupees, you're saying I'm going to put maybe 50 rupees in equity. About 7.5 rupees in addition should go towards, say, gold. Between 7.5 to 10 rupees should go towards gold, and the rest towards debt, right? Now, the second bit in terms of, so that's one aspect in terms of how do you build the portfolio, and you can build your portfolio. Again, you could take a very broad-based index, or even within the 50 rupees, you could kind of say that, look, I'm going to put X amount in large cap, X amount, Y amount in mid cap, and a Z amount in small cap, or you could just stick to large caps as well, depending on your comfort factor that may be. Now, one way for you to hopefully, all of us have to realize that, at the end of the day, higher returns comes with its own bit of risk. So
Sure.
if you want to kind of get that 2-3% alpha, obviously you'll have to take more risk in the market. One way to kind of take more risk than, say, a diversified 500 stock index would be to load up more to, on the mid cap side and the small cap side. But remember, one thing, it all comes with risk.
Right.
There is no risk without return. So one way to kind of enhance that return would be to kind of load your portfolio more towards mid cap and small cap. And the rest is the satellite bit of your portfolio, which is the portfolio where you could kind of look at playing around a little more with. Now, that strategy, you could kind of have sector bets in it. You could have thematic bets in it. You could maybe look at strategy as what they term as smart beta strategies, or you could look at active fund management in that portfolio, or any other kind of alternative asset class or product which you think will kind of enhance the return of your core portfolio. But beyond the point, the core portfolio is something that should be stable over a long period of time.
Right.
It should be disciplined. It should be stable. You should keep, not tinker around beyond the point with the weightages that you've decided, unless there's something really, different that happens in the market.
So the 80-20, the core is 80 and satellite is 20. Is there any science behind it, or it's more? How do I decide whether it should be 80-20 or 60-40? Is there anything that
I think it just depends on your risk-taking ability, Rahul. It's very difficult for someone like me to sit here and comment on what it should be. It was just an example that I gave, but
Right.
the best would be to kind of speak to an advisor,
Right,
and get a feel in terms of what that split could be, or you could yourself maybe sit down one day and chart out your path in terms of what are your short-term needs, what are your mid-term needs, what are your long-term needs, what are your goals in life, and then figure out how you could kind of build a portfolio by yourself. But all I'm saying is that these passive products makes it very easy for you to kind of build a portfolio and achieve your goals the way you wanted to. Another thing that I've experienced in my life is that don't have too many products in your, or I would say line items in your demat account, it becomes very difficult for somebody to manage it. Right. So instead of having those 50 stocks and those, another 10 different products that this friend called up and said, or this, broker or somebody called up and said, I mean, make your portfolio with very few line items, make the portfolio simple. It becomes very easy to manage it. If you need to kind of rebalance it or do some kind of course correction, is very easy for you to do it with just 5-6 items in your demat account rather than having a whole baggage full of them in your demat account. Yeah.
So you think 5 to 6 ETFs should be enough?
Yeah.
Because if you're saying that, let's say you've got large cap, mid cap, small cap, if you want to split it,
equity, 1 or 2 debt, and 1 commodity is all you require.
Right.
To build a meaningful portfolio.
And in debt, in particularly, are there a good range of ETFs? So I know liquid ETFs is one category, but I think in debt category, there are not so many ETFs as compared to what we see in equity.
So you have a 10-year.
Right.
You generally have products on the 10-year side, which come in 2 forms. One is a 8 to 13-year gilt. One is your 10-year gilt. Then you have a 5-year gilt as well.
Right.
And then on the short-term side, the one-day side, you have liquid ETFs, which are just one-day maturity. There are products which are coming into the market on the index fund side, which are 6 to 9 months, 9 to 12 months. They're there on the index fund side. You're right about the fact that the debt products on the ETF side are a little limited at this point of time.
Right.
Because replication of an index on the debt side is a little challenging at this point of time in India. Simply because of the fact that when you look at the debt markets, right, the lot size in the debt markets are huge. So any deal that you do generally is about 5 crores or so. Any government security that you buy, the lot size is around 5 crores or so. If you're not able to do that, then you need to go into the odd lot market and then buy smaller quantities which are there. But so what happens is that when you get retail flows, so let's take a simple example. There are fund house which gets retail flows. So if I get, say, 10 lakh rupees worth of flows coming in every day into my fund, it becomes very difficult for me to go and buy the underlying security, because of the fact that
the ticket size is very high.
So that becomes a little challenging in that sense. The second thing is that unlike equity, right, the debt papers keep changing. So they have this concept called off the run and on the run securities, right? Where if there is a new 10-year gilt which comes into the market, the earlier 10-year gilt the liquidity starts going down.
Sorry, can you, I think this is all good and new stuff for me as well, because debt is a component that I've not explored deeply. So gilt, first of all, let's start from basics. What is gilt? How does it work? Why is it a debt instrument? Because I'm sure a lot of people would not know about gilt. So can we start from there?
So gilt is government securities. Right. So they're backed by the RBI.
Right.
So in a sense, they don't have sovereign risk. I mean, the sovereign risk is zero.
Is it the other name for the bonds? Then are we saying that gilt and bond is the same thing?
I mean, yes, but usually government securities are called as gilts.
Right. Okay.
Bonds, you typically associate them with corporate bonds.
I see what you mean.
So I'm not talking here about corporate bonds, because corporate bonds then contain their own credit risk, whereas that is not there in government securities.
Right. And also you talked about 10-year gilt, right? So that is the maturity period of that bond.
Yes.
Right? Okay.
So generally, government issues 10-year gilts in the market. 5 years are also there. The government also issues long-term gilts, which are about 25 years or so. But generally, the 10-year segment in India, the BSE Sensex or the Nifty, which is like the benchmark in India, the benchmark for, say, yields in India is the 10-year benchmark, basically. Is the 10-year issue.
Yes.
Now, what happens is that because it has a fixed maturity, obviously as time passes, right, the maturity keeps coming down. So a year later, it'll become 9 years. 2 years later, it'll become 8 years, right? And then it's no longer a 10-year benchmark. So then the government will issue a 10-year benchmark. So the time when it issues the 10-year benchmark, the older 10-year benchmark starts becoming illiquid.
Okay.
Right. And therefore, every fund will need to then move to the 10-year benchmark. The new 10-year benchmark will come in the market.
Right.
Now imagine if it's a short-term product, right? And if it's like a 1-year gilt product, right, which has got papers with 1-year maturity. Now imagine how fast you'll have to keep rebalancing your portfolio all the time, because in a month or two itself, right, the security that you were holding in your portfolio starts becoming illiquid, and the newer one starts becoming liquid. So there's a huge amount of churn that will keep happening in the underlying portfolio. And therefore, debt on the passive side is not very easy to kind of replicate at this point of time. A 10-year, a 5-year is then too doable. Coming a little down in the maturity spectrum, where actually a large part of the Indian market is there, is a little challenging. But we're kind of working on it to see how we can launch more products, on the shorter end of the curve, which will then become meaningful for investors to kind of plug into their portfolio and have different maturities.
So for now, then the easiest debt instrument, wouldn't that be liquid ETFs then in that case?
Liquid ETFs, but that just liquid ETFs in a sense is cash in your portfolio.
Exactly.
So you could kind of combine maybe a 5-year, if you take a 50% 5-year and a 50% liquid ETF, it gives you a kind of 2.5-year maturity.
Okay, I see what you mean.
Right.
Okay.
So you could mix and match, and depending on your maturity, use these two products to kind of build that maturity curve that you're looking at.
Right. Vishal, you did not touch upon the global ETFs, because actually in US, the ETFs it's really big, it's really huge, right? We just cannot compare any other country with US when it comes to ETFs, right? So would you not also think about going for diversification and adding at least 1 or 2 ETFs from, let's say, US market or any other global countries? Or would you just say that, no, let's stick to Indian market?
I mean, diversification is always good, Rahul. And so depending, again, on your risk-taking ability, I would say that, definitely diversify into international markets. The US markets definitely are the more evolved markets that are there. But I mean, in terms of, it's a judgment call on any individual, whether you think the Indian market is going to give you higher returns or whether it's the US markets that's going to give you higher returns. I would tend to think that for thematic plays, or for, a lot of us now in this age of AI and technology want to kind of take exposures towards sectors and segments that are not available in India.
Right.
So if you get an ability or, to take exposure to those kind of sectors like a NASDAQ or any other kind of thematic plays that are there in the market, definitely go for it.
Right. Okay. So, if there is a reason in terms of, let's say semiconductors, for example, or data centers or gold miners, those sort of areas, if you want to explore, then of course there is no availability in India, therefore, or very limited. Therefore, you go and explore US ETFs.
And the second reason is if you really believe that the US economy is going to do much better than the Indian economy, then you go and buy the
rupee depreciation is another factor, of course, right?
Possibly.
Okay, so let's say 5 to 6 ETFs should do the justice here. Now, within the large cap, for example, Vishal, there are, 20, 30 ETFs. I will not be surprised if there are more than 20 ETFs. Let's now speak about how do I go and pick those ETFs, right? Because there are a lot of factors, be it the expense ratio, etc. What are the top 2-3 things that I need to look out for to say, okay, you know what, this ETF is fine and I'm going to stick with it for the next, let's say, 3, 4, 5 years?
So, again, in both, whether it is, ETFs and index funds, for any passive product, the most important, I would say, statistical number is what you call as tracking error.
Tracking error, okay.
Right. So generally this tracking error is something which is available in all fact sheets. Usually a lower tracking error means that a fund is being managed better. Now, what exactly is tracking error, right? It's a slightly difficult term, even for me to kind of explain on a forum like this. But in very simple laymannish terms, it basically tells you how a fund manager is tracking the index on a day-to-day basis. Right. So basically, you look at, so let's take a simple example. Today, the index has gone up 1%, whereas your portfolio, which was tracking that index, has gone up only 0.99%. So the difference is basically 0.01%. Right. Now, you take that difference on a day-to-day basis for a span of 1 year, which is generally about 250 trading days. Right. And so you'll get 250 data points showing you how exactly, so on one day it might be minus 0.01%, the next day it might be plus 0.01%, and you'll get an entire series of 250 data points. You take a standard deviation of that data point,
right,
of all those 250 data points, and that number is what you term as a tracking error. It basically shows you how closely on a day-to-day basis the fund manager is tracking the index. So if it's 0.01% and every day is just 0.01%, then you'll have a very low tracking error. But assuming that you had one blip one day, where it became 0.25%. Suddenly you'll find that, out of 250 data points, that one data point has completely skewed the tracking error figure.
Why does this tracking error actually occur? So if, let's say, just taking an example here, Nifty 50 ETF, there are 50 stocks. The AMC that has launched the ETF will have those 50 stocks in there, and the percentage in which the Nifty 50 is built with, the same percentage should ideally apply. But then why would the tracking error will come?
I mean, if the fund manager, for whatever reason, has not been able to track the index,
right,
it could be due to a rebalance. There are companies coming in, going out, or there was some suspicion he was not able to kind of deploy the money, or something, an untoward thing happened in the market where, you were hitting a basket of 50 securities and it got stuck. I mean, it could have been due to any operational reason.
Right. Okay. So the intent of the fund manager is to exactly replicate the index, the 50 stocks in the same percentage, but there might be reasons due to which it gets misaligned.
Yeah.
Okay.
Those are rare.
Yeah.
But they can get misaligned. So the smaller the tracking error number, the closer the fund is tracking the index, right? That's a very important parameter to look at, and because tracking error is calculated based on NAV. Right. Obviously, the expense ratio of the fund is already factored in. So if the expense ratio is high of the particular fund, it'll get factored into the NAV, and you'll find that differences between the index and the returns that the fund is giving will be higher than what a fund with a lower expense ratio
would do. Okay.
Right. And therefore, that one number is something which tells you how gives you the entire dynamics of that fund in terms of the way it is being managed, right from the expense ratio to how it's being managed on a day-to-day basis. The second, then, other important thing is liquidity on the stock markets, right? You would obviously tend towards or go towards any ETF which is more liquid than you tend towards the most liquid ETF in that sense. So obviously liquidity is something that is a very important factor for an ETF. For an ETF and an index fund, tracking error is definitely an important factor.
So liquidity, right? I just want to understand this a bit more. First of all, how is the liquidity calculated? What is the metric for me to say that this ETF has got higher liquidity versus this ETF that has got lower liquidity?
I mean, that data is available on any of the exchange websites, right? Where they tell you in terms of volumes or
volumes.
Total, basically traded value.
Traded volume or value?
Value.
So what crores, number of 50 crores, 100 crores, 1,000 crores, that is telling me the liquidity, is it?
Again, yeah, exactly.
Okay. And that's changing on a daily basis because depending on how much trades are happening in the market.
Yeah.
That could change. So do I look at yesterday's liquidity or do I look at some sort of average
you could look at average. You could even look at current liquidity. Right. A good way to obviously see it over a span of maybe 15-20 days or a month or so.
Right.
Is a good number to kind of look at in terms of liquidity. Generally, you'll find that the longer the product has been there in the market, the more kind of liquid it becomes. So the legacy products which are there will obviously attract a lot more liquidity because they've been listed for a much longer period than a lot of others have. But liquidity is improving across ETFs in the Indian market. I mean, if I remember, data, the previous financial year, the total traded value of ETFs was about 4 lakh crores for the entire year.
Right.
This financial year, I think in the first 6 months, we crossed 4 lakh crore.
So, okay, half the time period, but we've already hit the number.
They're quite liquid now in terms of, especially the diversified ones and even the commodities have become quite liquid on the markets.
So, if liquidity is higher for an ETF, and let's say I've got 3 ETFs which are showing me very good liquidity, then that should be fine, or within them also go for the highest. I mean, I'm just trying to understand if let's say one ETF is very highly liquid, what is the advantage it is giving me? Is it the ease of buy and sell, or is it something like, I don't know, I've heard the concept of impact cost. Is that what it is? So why do I need to go for, out of let's say top 3, the top one, not the second or third?
It all depends in terms of what is the size of trade, right? Impact cost is a number where you hit a large quantity, right? It's basically the difference between the top. So let's take a simple example that you have a bid which is 99.50 and an offer which is 100.50, right? For any, I'm just giving an example of a bid and offer. So you take the average of that, which becomes 100 rupees, right? And if you were to kind of invest, say 1 lakh rupees or 10 lakh rupees in that product, how much down the order book do you need to go to be able to buy 10 lakh rupees worth of a security, right? So let's take a simple example that the best offer was at 100.50, and by the time you bought 10 lakh rupees worth of any security, whether it's an ETF or any stock, and you landed up paying 11.50 for it, right? So 1.5 rupees the impact that you paid for buying, 10 lakh rupees worth of a security.
Because there was more demand for that ETF.
No, because there wasn't liquidity on the counter. There wasn't
I see
enough.
what you mean.
So you landed up paying 1.5 lakh. You saw the average of the best bid and offer was 100 rupees. But I landed up paying, another 1.5 rupees to buy my quantity. Right. But similarly, if you bought 1 lakh rupees worth, maybe you paid only 25 paisa more. For 10 lakh rupees, you paid 1.5 rupee more. Right. Now, the more liquid any counter or any security is, the gap between the midpoint versus what you're paying to buy that security is very low. Low. So that's the low impact cost, is what you're talking about. Now, if you're an institution, or if you're doing a very large trade, then going for an ETF, which is the most liquid, yes, obviously makes sense, because your impact cost of buying that security or selling that security is much lower. But if you're a retail investor who's buying retail lot sizes, then it's not such a big factor for you to kind of consider. It's you should look at liquidity, as well as you should look at other factors such as tracking error and everything, which is there for every investor. But you don't need to go for the most liquid one at that point of time.
Right.
You could go for any of the other products.
Second or third as well.
Yeah.
And I think this impact cost, I saw the data on the NSE, and NSE shows us that data. For each ETF, it says that this is impact cost 0.32% or something like that. So there is no harm in looking at that number, because it is very easily visible to us. So why not look at it?
Correct.
But you're saying that don't really go too deep into I have to go with the first liquid ETF. Actually look at the liquidity and top 3 or top 4, which are the most liquid one. Look at their tracking error, maybe look at their expense ratio, maybe, and that should be good enough. Or is there any other factor?
That should be good enough.
That should be good enough. What about the price of the ETF? Because of the trends in the gold ETFs. So for example, it is entirely possible that one gold ETF is priced at 100 rupees. The other one is priced at 10 rupees for whatever reason. Now, what I have noticed is that a 10 rupees gold ETF is actually more liquid. And this, I don't want to name that here, because we don't want to get into that discussion here, that which ETF I'm talking about. But I saw the last 3 months average volume for that 10 rupees one was much higher. Do you think that people want to go for the lower price one, or it doesn't really matter?
No, I think, see, those guys who want to kind of have a lower ticket size in their portfolio. I mean, let's take a simple example that there are people who want to just put in maybe 500 rupees a month. Right. It becomes then easy for them to go in for a lower ticket size, of an ETF. So we do find that the lower ticket size ETFs tend to get more volume.
Right.
But obviously, one of the factors that you should look at is also the value that is traded in the market.
Of course.
We definitely believe that in the Indian market, by lowering the ticket size, you're actually lowering the bar for more and more people to come in.
Okay.
Right. So that's the main objective.
Right. And what about the concept of INAV, indicative NAV, versus the trading price? Because I personally have benefited by that I look at the INAV of ETF and say, okay, the INAV is actually 100 rupees, but it's trading at 102 rupees because maybe the demand is higher for this ETF. It got misaligned for whatever reason. Therefore, rather than that combination, I go with something like, if INAV is 100 and the trading price is 100.05 or 100.10, that's only that the spread is low. So would you say that also should become the parameter, or you think, no, actually that you shouldn't worry about it, because ultimately you're buying an ETF and you're going to sell it back at some point in time?
No, that definitely is a parameter, and good you brought up that point, Rahul. INAV is something which even the regulation states that every AMC has to kind of disseminate on their website. So investors should definitely look at the INAV and invest. But generally, I find that these days, that because liquidity has improved a lot in the ETFs, they all trade very close to the INAV actually.
Right.
in general, unless it is, products like the gold ETFs, which tend to kind of differentiate a little bit more from the INAV. But especially the equity ETFs trade quite fair and close to the INAV on a day-to-day basis.
Right. I think there are few days where I saw, for example, I very vividly remember this. Election day, 2024, yes, yeah. The election day, the BJP won that day. Huge volatility in ETFs during the day because the seats were getting counted. Okay, BJP has got 30, Congress or whatever, NDA has got 10 or whatever, right? The counting was, and the moment it started to reverse, right? NDA started to get for like a momentary 20 minutes or 30 minutes period, they started getting more seats. Okay, and I was live in the market at the time, and I saw the swings in the ETFs. All of a sudden, market fell, right? And you see like Nifty falling down by, let's say, 5%. ETFs were falling down by 8%, 9%. So they were not able to, catch up to the Nifty fall. And I wanted to ask you, how during the day ETFs why do they get misaligned so much? Not every day, of course, not every day. I totally get it. It's only on those specific days where it's all of a sudden, there is something going on in the market and the ETFs prices, or the drop or the rise is very different from the index. So why does that happen?
So remember one thing, Rahul, see, an ETF, a lot also depends on, or the way it is structured is that the ETF requires market makers.
What is market makers?
Right? Now, market maker is somebody who creates or who provides liquidity on the counter. Right, on every ETF counter. So whether it's equity, whether it's debt, whether it's commodity, the ETF, because it is priced real time, right? You require market makers to kind of provide liquidity, come and give bid offer quotes on the counters so that people can kind of buy and sell. Now, market makers are also guys who can create and redeem in bulk lots with the asset management company, right? So they buy bulk lots from the asset management company and then they retail it out in the market based on the bid and offer that is prevalent at that point of time. Now let's take a simple example that, Rahul Jain is a market maker, right?
So market maker could be an individual or is it a company?
No, it's usually a company. It's usually a prop. It could be a broker.
Okay.
It could be any entity which has the ability to kind of take risk, has a large amount of capital to play around in the market, that does a lot of futures, options, and also looks at any kind of mispricing that happens in ETFs. So there are quite a few entities in the market.
But they're different from AMCs.
They're different from AMCs.
So independent of AMCs.
Yeah.
So you've got AMCs and you've got market makers.
Yeah.
Okay.
Yeah. Okay. But AMCs keep control in terms of the bid and offers that they're quoting. Right. So obviously, one of the main jobs of the AMC is to ensure that their counters are trading close to the fair value.
Okay, sure.
Right. So that is one important job or one thing that the AMCs always kind of look at. If they feel or if they find that it's going out of whack, they'll call up the market maker and they'll tell him that you need to kind of
do something about it.
Do something about it.
Okay.
But you have to remember one thing. See, at the end of the day, Rahul, every product has got a certain ecosystem, because of which it works properly. And if that ecosystem breaks, right, then you'll find the product also going out of whack.
Right.
What could be the breakage in the ecosystem? Breakage in that ecosystem could be that, let's take a simple example that one day the government comes and says that, look, I'm going to ban gold imports into the country.
Okay.
Right. Or like what has happened currently where the international limit for ETFs has stopped. Right. Now, the day you kind of do things like that, where today in an ETF where a market maker can easily subscribe and redeem, right, where the fund is open and he can kind of control prices based on the liquidity of each and every asset class. But if you go and block that asset class, or if something happens to the underlying asset class, there's very little that the ETF can do, because what has happened is that you've kind of broken the entire chain.
Right.
Like during COVID time, right, the entire country is shut for 2 or 3 months.
Right.
There is no movement of gold coming in, going out, or any such thing that is happening in the market. Right. That breaks the entire ecosystem, due to which the ETF goes out of whack.
Right.
The second time it can go out of whack again is if, besides the underlying, the other important part, the kink in the in the ETF is the market maker. Now, due to whatever reason, his systems go down, or market makers also don't have unending amount of funding with them, right? Because at the end of the day, he needs to, have funds, come to the AMC, create those units, sell those in the market. If for whatever reason the banking system is down or the market maker has run out of funds, that is when you find a lot of these
swings,
movements away happening from INAV. Also, put yourself in the shoe of somebody who's a market maker. When you have an event, right, where there's so much of swing happening in the market, how does one hedge his portfolio, right? So let's take a simple example that you come to Vishal and you create, say, 1 crore worth of, one of his ETFs, right? But you're slowly retailing out 5 lakh rupees worth, 5 lakh rupees worth, 5 lakh rupees worth. The entire 1 crore is not going out in the market, right? Now imagine the rest of the portfolio. You need to hedge yourself.
Correct.
Right. Otherwise, the swing will kill you. Right. And therefore, because there are huge swings in the market makers will also kind of widen their spreads to ensure that, they don't make too much of loss in that trade. Right. That's what happens. Right. In a normal circumstance, you'll find every product kind of running properly, but there will be those instances when something has happened in the market. Either there has been, like what we're seeing now, war situations happening, or there is some event which is happening in the market which is leading to a lot of volatility, and the guy who's actually giving the pricing is not able to understand, which side he should be on, or, he's scared due to whatever reason in terms of not being able to hedge his portfolio, is when those kind of, gaps from the INAV kind of start happening.
Right. So market makers during the day go and request the AMC to say that, okay, issue me, let's say, 1,000 units or whatever of ETFs, and then they will sell it to retail people if they feel that there is an arbitrage for them to earn. And they could also do the reverse, that they can say that, I'm actually going to sell you, Mr. AMC, here is the ETFs, take them, because I'm going to buy them cheaply from the market and I'm giving it to you, earning some commissions in between that.
I mean, commissions or whatever you may call it. I mean,
there's a difference in the buy and the sell price.
Right. Look, so I'll explain this with an example. I mean, let's take a simple example that there is a product A, whose indicative NAV is 100 rupees. Right. Now, generally, if it's a diversified basket, so let's take a simple example. It's a Nifty 50 product. Right. And the underlying 50 securities are liquid. They're easily hedgeable. You'll generally find the spread or when a market maker will jump in, right, will be about 0.2% on each side. Right. Which means that if the NAV is 100, if it comes down to 99.8, then he sees that there is some way that he can make arbitrage, or if it becomes 100.20. Now, why this 0.2% I'm saying is a cost? Simply because for any market maker to come and create with the asset management company, he needs to buy the underlying 50 securities. Right. To buy the underlying 50 securities, the STT itself is 0.1%.
I see.
Then there is brokerage and turnover tax and etc. I'm adding another 3 or 4 bips to that, plus his funding cost, because at the end of the day, he's borrowing from the bank and funding that trade.
Correct.
Right? So I'm saying, so therefore, technically his cost turns out to be about 20 bips on either side.
Right.
Now, if there is, so let's take a simple example. As I mentioned to you, 100 rupees ka NAV hai, right? Now, for whatever reason, on that particular day, somebody starts selling units on that counter, or a lot of people who start, coming and selling units on that counter, and the price starts getting pushed down to 99.8, 99.75. Now, at that particular price, he will start buying the units.
Right.
From people. He'll start buying the units and he'll come directly to the fund house immediately for redemption.
Right.
That's how he's kind of ensuring that, he's absorbing all the selling, right? And because of his buying, it is not going down further to 99.5 or something like that. Similarly, if it's 100.20, if there is a lot of buying happening on the counter and moves to 100.25, 100.30, 100.40, he'll start selling units and come to the AMC and directly create. That's how we'll ensure that at any given point of time, it's trading close to the fair value, of that particular scheme. Now, if it's a sectoral, or if it's a thematic, or if it's any of these other, non-hedgeable, I would say, products, you'll find that the wider, the spreads are slightly wider than what it would be for a diversified product.
Right. Okay. No, I think this is very, very good. So, because market makers are making money out of the people who are actually buying and selling, because somebody is losing the money here, right? When they are buying ETF, and that's the profit that market makers are pocketing, isn't it?
Not really. I mean, look, at the end of the day, you need somebody. The structure of an ETF is such that you need somebody to come and create units, to buy and sell those units, right? And to ensure that the counter is working, close to the fair value, right? And that's the job of the market maker. So today, even if you go into an options market, there are market makers there,
right? Okay.
Right. So that's the job of a market maker. He's the guy who comes and creates liquidity. He's an expert at creating liquidity in the market, right? And so whatever is his cost of creating that liquidity, is his cost of creating that liquidity, right? Remember one thing, in an ETF, you are getting the real-time ability to get in and get out.
Yeah.
And somebody is giving you that ability, right? So imagine, even if you looked at historical intraday movements, historical intraday movements on an average is between the high and low. If you look at the gap between the high and low, in for a Nifty is about 1.5%, right? Which means that if you're able to capture that 1.5%, right, you've been better off than you buying a product which is at the end of the NAV.
Yeah.
Right?
Correct.
But that's if you're able to kind of buy at the low of the day and sell at the high of the day. Right. But I'm saying that these products give you that, that ability to go and buy and sell at a real time price.
Right. Exactly.
Right? So if the market is down today at this point of time, it gives the ability to sell and get out.
Yeah, exactly. I think this is why I personally like ETFs. Yeah. And as I was telling you, the election day, that day was a beautiful example in front of me, actually seeing that Nifty is fallen by almost 4%, but ETFs are down by 7 to 8%. Because eventually they catch up or they get aligned, right? But for me, that was a clear window of, don't wait till the day end if I were to take a bet in Nifty at that day. Because I know in mutual funds or index funds, I'm going to get the end of the day NAV. But here, live, I'm able to transact, and that is quite beautiful. And also, whenever I have to exit something because of some bad news, right, all of a sudden, then that gives me that ability to go and exit and, do that. So, no, I think we got into too deep the technicalities of ETFs. But actually, to my viewers, I just want to say that ETFs is a beautiful product. You don't need to get into this level of technical understanding, but we tried. We tried to sort of give you that flavor of what goes behind the scenes so that you understand it and understand that ETFs is a beautiful product. I mean, in US, it's traded like anything, right? So there are advantages, of course.
The most liquid stock in the world is an ETF. Right?
ETF, Vanguard's, ETF.
It's a spider. It's the one that's traded on the market. So it's the most liquid stock in the world today.
Yeah, and I wanted to ask you, do you have any favorite ETF?
I like the diversified ones. I mean, I've always been a fan of them. Even when we launched the first ETF way back in 2001, personally, I mean, I bought my first car, my first house, all with the savings that I put into that ETF.
Oh, really?
So I have that soft corner for for the diversified ones. Yeah.
And if you don't mind, I mean, you can say no, Rahul, I don't want to reveal it. What percentage of your investment actually is via ETF versus other means? Do you remember it, or do you have any preference? Is what I'm trying to get to.
I mean, my first preference is ETFs. I mean, all throughout my life, even because of the fiduciary responsibility that we have, we can't do so much of stocks in that sense. But my preference has always been towards ETFs. Again, because on a day-to-day basis, you don't have that ability to track your portfolio because of your work. And therefore, my portfolio, as I mentioned to you, I again keep it very simple here. I mean, I've seen over the last 15, 20 years, seeing helping my friends and helping a lot of people in the market. I find that our portfolios now over a period start looking like a cupboards here. You don't know why you bought this color, this clothes, and suddenly one day you open the cupboard and everything is falling down.
Yeah.
I think our portfolios over a span of time become the same, and I think it's important that you keep it simple and easy for you to control. Otherwise, on a bad day, you don't know where it goes here.
No, brilliant. And I totally resonate with that. That don't just consume a lot of content and say, okay, this is good, I'll take that and build a basket, and that basket is so full that you don't know how to rebalance it, how to exit and when to exit, etc. So this is really good conversation. Thank you, Vishal, for all of this. I very swiftly will ask you few 10 rapid fire questions. Okay. They may belong to investment world or may not, right? Let's just, do a random rapid fire. Number one, MBAs, do you think they're necessary in current world or not?
I mean, yes. I mean, MBA gives you an insight into how a company runs. So I think it's very good for somebody to understand that.
Yeah. Okay. The reason I ask is there is a lot of different point of views on MBAs, right? So okay. So you believe in MBA, traditional MBAs. Okay. What about owning or renting a house? Where do you stand? Which camp are you in?
I would prefer to own a house. Yeah.
Do you own a house right now?
I do own a house.
And you're happy with that?
Yeah, I'm happy with that.
Any specific reasons?
It just gives you a sense of stability and comfort.
Security. Okay.
Yeah.
What about credit cards? Do you use credit cards? Are they good, bad?
I like them.
Okay, that's good. Because somebody else is paying your bill at least for 30, 40 days.
You get that ability to kind of manage your finances for a little longer. That's all.
What about home loans? Do you think they're good or bad?
I think buying a house is a good asset to have, especially your first house where you're going to live in is important to have. And I don't see any reason why it's bad to take a loan for that.
Right.
So because at the end of the day, it's an expensive asset, right? And therefore you need to take that loan to be able to pay it over a span of 15, 20 years.
Yeah. If you're going for a 3 crores house, you're not going to have 3 crores with you. So there is no other option.
Exactly.
Right.
Exactly.
According to you, one golden rule of investing?
Discipline.
Can you elaborate a little bit more? I know it's a quick rapid fire, but I still want to know why discipline.
Deciding on what to do on a day-to-day basis, right? Decide on one chart. Chart your path out in the right way and ensure that you're investing at regular intervals. And that requires, in my opinion, a lot of discipline. Whether it may be investing those small amounts, staying by the course. We're so exposed to information on a day-to-day basis that we tend to change, or our minds start wavering depending on what's happening in the market. So having a longer term view, investing small amounts on a month-to-month basis, that, in my opinion, all these things require a lot of discipline to stay away from the noise, to ensure that you are doing what you need to do and that you have your objectives in mind over a longer period of time. Requires a lot of discipline, a lot of inculcation of that discipline in a human.
There is a lot of itch that comes with watching so many things that you get dragged. Mutual funds and PMS. Which side do you stand?
Mutual funds.
Mutual funds. Your biggest investing mistake so far, if you've made any mistakes?
Same thing in the sense that having too many products in your demat account, confusing. It basically confuses. You don't understand how much risk you've taken in the market.
Right.
And to me, that you only wake up when there's a big crash in the market, right? That you don't realize that you've taken so much of risk. So a big learning has been to keep the portfolio very simple and very small.
Right. Your biggest success of investing, any that you remember?
Again, diversifying my portfolio. So doing an asset allocation.
Right.
The fact that during bad times, gold kind of, shoots up is something which I learned on the way.
Right.
And I've inculcated that in my portfolio, and I stand to benefit even today with that.
I truly resonate with that, because I also made a mistake of not having gold in I was like 100% equity investor. But then now I realized, no, that's not good. And I started doing SIPs in gold, because I thought you can't really predict the prices of gold. What will happen tomorrow? There's like no logic. At least in stocks, you're looking at valuation, but in gold, what is the logic? There's like literally no logic.
I've seen that happening across. Even the 2008 financial crisis. And if you look at that, it's gold that saved everyone.
Absolutely. If you were to go to dinner with a celebrity, who would that be and why? Anybody, live, dead, past, present, future. Not future, of course.
I can't think of anyone here. No.
I thought you were getting a lot of names in your mind and you were confused to pick one.
I'll pass this one.
Okay, maybe you think over and let me know offline. I would love to know. Any recommendations for me for my next guest? You would say, you know what, Rahul, this is a person I really I admire, want to listen to them. I don't know whether they'll say yes to me or not, but at least I ask this question to every guest of mine just to understand who are they looking up to when it comes to listening and watching.
So I think, not an Indian. So this book, The Psychology of Money by
Morgan.
So I think it's fantastically written.
It is actually,
and I think it's so apt in terms of all the time we're looking for the best stock, the best, uh, to outbeat the market. How can I do better than someone else? And we don't realize that finally the markets are made up of humans only.
Yeah.
And that we are the guys who are trying to fight with each other in the market on a day-to-day basis, and we forget the psychology angle, because the market has been created by humans.
Yeah.
Right. So I think it's a big eye opener and would be a good conversation to have with him.
Absolutely. I'll do my best to do this with Morgan. Vishal, thank you so much. I've truly enjoyed, and we have gone deep into ETFs, and I hope my viewers did. So once again, thank you so much.
Likewise, Rahul. Thanks for inviting me.
Thank you.
Pleasure.
Thank you. If you haven't yet subscribed to our channel, humble request that you hit the subscribe button now, because your subscription is our motivation. My team and me gets really motivated once we see your subscription. So please hit the subscribe button now, and I'm going to see you very soon. Until then, keep rocking.